Good morning and welcome everyone. This is the GoldFields meeting for March the 2nd, 2026. Of course, we begin today's meeting with all the stress with the Iran bombing and its effects on markets. Oil is going up by a lot. Equity markets are dropping more than 1% as of now. We will analyze its implications and uh, all the developments, all the critical analysis for our investing. So, uh, our call, if you remember from the other meetings, that the oil was relatively too cheap if you compared it to other commodities like gold, especially monetary commodities like gold and silver. And we were afraid that something would cause the oil price to spike very soon, and it happened. Okay, we didn't expect the war exactly, but we knew it was cheap and at least we should never be short on it. Also, there were some rumors that US and China were buying aggressively for their strategic reserves when the prices almost hit 60. So I think it was a good idea. Markets will probably forget the tariffs and the Fed talk for now. And we know that if gasoline prices move up, it will be bad for Trump's popularity on the long term. So, short term, the victories look positive. And regarding the other markets, Japan, we remember from last week that their disinflation policy was mostly based on transport costs going down. And so, what happens now if probably with oil going up, gasoline going up, everyone was relying on cheap transportation costs. So we'll see how it unfolds from here. Realized losses on domestic bond holdings for Japan's four largest life insurers jumped 125% year on year on the fourth quarter to a record $86 billion. Oh, that's a big number, okay? Regarding Brazil, oil price will probably be seen as BRL positive. As of now, the BRL is losing almost 1.5%, which is a lot. It may be probably will be seen as an entry point for a carry trade by foreigners because our main export items are going up today. So first export item for Brazil is oil. It is going up by 8% now. Meat and poultry, which has been the prices have been climbing. Iron ore relatively stable but trending upwards. And soybeans also the prices have been on the rise. So the BRL has benefited from this and also from investment inflows. Okay. So for you, starting with US, the downside scenario where the Fed is cutting rates despite inflation picking up now has become a little bit more probable because we may see unemployment numbers rising with the AI productivity and etc. and oil prices spiking at the same time. So this stagflationary scenario may unfold. So far, market is still pricing the first two. Okay. What caused our attention is that on Friday, rates were collapsing. So our question is: did the bond market really know what was going to happen? Is it the fall of Iran or the fall of liquidity that caused it? Okay. The world economies are still doing okay. US is growing. What is behind the scenes? So let's analyze it. Liquidity watch. We know that there is a big debt maturity wall coming in the 4 or 5 coming years. Typical debt cycle is on 5 years. Financial markets have become a big instrument of debt rollovers more than financing new ventures and new capitalists. So we know how important this is. So far, it's been balanced. Rates are collapsing, as we can see looking at European rates, dollar rates, but we know there's some danger ahead. We will be walking on thin ice regarding this situation. Okay, if there's an imbalance, we can have a financial crisis. But so far, it's on equilibrium. There have been inflows to fixed income funds, and debt rollovers have been going on without any stress. Okay, regarding the major market for the money market, the biggest money market of all, where we compare the SOFR rates against interest on reserve balances, which is mainly private versus public collateral. Uh, it is almost the same rate, so stress is being controlled by the Fed here. We we remember that if this difference starts spiking, it's because the market is short of funding. Bitcoin, which has been leading on dollar liquidity, is still not going anywhere because dollar liquidity hasn't moved by much. We may see an increase going forward from here, but so far liquidity is a leading indicator, so we better not try to forecast it, just follow it. And Bitcoin is following liquidity, so that's the reason why it's dropping. So Bitcoin has been more linked to dollar liquidity and gold to Chinese liquidity. Reverse repos are on the low, so liquidity has already been put to work. Bank reserve balance is also uh, on going up by a little, but not moving much. We know that if we break this level, we may see some stress in funding again. The Fed may have to act. Last data release from M2 money supply growing only at 4% year on year. This is in line with low inflation going lower. And if it doesn't accelerate, we'll probably have controlled inflation from now on. But we don't know if bank credit is going to accelerate because the last number was a little pop here, almost at 6.5%. This is helping sustain the real economy. So we know that GDP is credit available to economic activity in the end. So if credit starts going up by a bigger rate, then we can have a further acceleration in economic activity, GDP, etc. And it looks like it is going higher, but we only have one observation, so we have to wait a little bit. Other ratio that we look at is gold versus the M2 money supply. We broke through 2011 levels, and if we were to catch this 1980 level here, this would mean that gold would have to almost double the price from here. So we would be talking about $10,000 gold an ounce. Will be a there's a long way to go, but it can happen if wars start happening all over the place or something like that. We are in a dangerous situation right now. The market is panicking, and so gold has been seen as a safe haven, which actually is. Uh, Today we see a firmer dollar. I still think that for DXY 100 is the key level. If we break it, then the market is going to be more stressed. But so far, it's been contained. We may see a trend line here. We may stop here. The thing is, at least for me, I know when the market gets nervous, it looks for safe havens such as gold, the dollar, etc., etc., treasuries. But I think that because of wars need funding, need deficit spending, in the end, uh, it may not be very good for the dollar. So I would be skeptical of buying dollars here. Okay. Regarding the odds, so the market is pricing no changes on next Fed meeting now in March. Remember that in March we have this SEP projections, economic projections, summary of economic projections, which is important, may move markets. For December, this was last week probabilities, and this is for this week. Probabilities haven't moved much. Slightly to the left to more easing, but not significantly, not enough to move the dollar. Okay. GDP now from the Atlanta Fed is strong, 3%, and the New York Fed nowcast is ranging at 2.38%. Also a good number, not very strong, but still a good number. Personal income has been on the rise. This helps the American consumer to stay on its foot, even though we know that cost pressures are discouraging some people from spending more. Leading economic indicators still last reading from December. We just highlight here that part of its force on the positive side comes from the S&P stock index being on positive and creating a wealth effect. So if equities start to tank, then we may have a problem here, okay? And economic indicators could go to recession area. Let's see how the situation unfolds from here. Inflation nowcasting. Inflation is very well contained so far. The current readings from last week for CPI, just 2 basis points higher for the not for the core but for the main number. PCE also 1 basis point, not much difference. This comes from the Cleveland Fed inflation nowcasting, okay. And most importantly, break-even inflations, because rates have been going down. Break-even inflations are contained at this 225 level. At least in my opinion here, I would be paying rates, the nominal rates, and buying tips on the opposite way. I like investing in tips still at these positive levels, but I think that on relative, I would be shorting the regular bonds and buying the tips. Okay, I'll be invested in this low inflation, betting that inflation may go up. Credit spreads, private credit spreads, they have been climbing by a little bit. If we break this 300 basis level, we may see some stress. There are some people talking about stresses in private equity markets where people cannot redeem their funds, but they would wish to. We don't know if it's true or not, but we have to keep an eye on this market because this has been growing and compressing spreads at the same time. So we may have a dangerous situation here depending on the economic outcomes. But so far it's okay. A junk ETF is on top of its averages. If it breaks it lower, we may see some stress. There was some good volume on selling last week. So technically speaking, not very good. For the week ahead, we thank JP Morgan for this agenda. Very good. Uh, We have some activity numbers for today, may influence GDP forecasting, PMI and ISM. On Wednesday, we have private data for employment from ADP, and we will watch employment numbers on Friday. This is probably going to move the markets. We have some auctions, big auctions for government bonds. Remember, we spoke of the debt rollovers. Now going to equities. Now, last week we mentioned that for the first time in many years, the PE spread between a big tech company like Microsoft and older company Exxon that drills oil, they converge for the first time in many years. So they're trading at the same PEs. There is some premium for the multiples of Exxon, and the premium in Microsoft reduced a lot due to the AI threat. We also mentioned that earnings have been beating in the US, growing at 12% a year. Healthcare is the only sector lagging. And in Japan, it's interesting that despite all the foolishness with equities, earnings per share are not moving anywhere. It's only headline numbers, sales that have been going up, but actual earnings per share are not moving. But in the US, it is doing very well actually. 12% a year has been realizing every year, beating. It's impressive. Uh, Nvidia last week released its results. First reaction was positive, then the market felt the heavy selling here. You can see lots of volume and the stock crosses its averages. Technically speaking, this is not good, so have to keep an eye here. MSTR, which is a leverage bet on Bitcoin, it may be trying to find a bottom here. It is a good addition to a portfolio that intends to protect against possible liquidity injections in the future to balance debt rollovers or something like that. New QE or something like this, or helicopter money. I think that it would be a good addition to a portfolio in small sizes, okay? Uh, the S&P 500 now working on top of its averages, threatening to break lower, also on good volume, not very good. Regarding the S&P versus gold, this is reaching multi-year lows, almost back to COVID levels. But if we go back to 2011, there's a lot to go down still. Okay. Ratio between bonds and stocks. This is important because this is the best recession signaler so far. If stocks start to tank, and bonds go up, this ratio is going to collapse down, and this means that market believes economic activity is coming to a halt, earnings are not gonna expand anymore, and everyone is buying treasuries because economic activity and inflation are going down. Okay, so a little sign of danger here, but still we can see how far this has gone, so have to wait. If it keeps dropping, then I would be very skeptical. Okay, IWM still trying to keep on top of its averages, keep the bullish trend. The bank index also remember that banks are the irrigating arteries of the economy, its vessels. So if banks start performing poorly, it is not a good signal for the economy, for the real economy. The bank stocks were climbing, were reaching new highs, and all of a sudden they reversed. And here on good volume, crossing the averages. Have to pay attention here. Regional banks almost the same. Some selling, going to the averages, heavy volume. Home builders slightly better. Some researchers say it might be a little pricey. And Walmart is a good name because it benefits. If there's cost pushing overall for society, people might prefer spending on cheaper things and move their preferences to lower standard products. And Walmart sells lots of those, and they may benefit. So that's the reason why their stock has been on the climb. Here we have the S&P on the highs, adjusted by M2, still very stretched. VIX today spiking. We would like to see a 25 reading to start looking at long positions, but perhaps wait for it to go through 30 and a little bit more of panic. And this implied correlation would have VIX north of 30 and implied correlation north of 25 would start signaling a possible contraindicator for buying. Interesting to note from our friends in Spot Gamma, they sent this map from implied volatilities. Market was very bid for puts on IWM and high yield, and very bid for oil calls. So it makes me wonder if somebody knew something in advance. Okay. The implied correlation index has been a good contraindicator. Whenever it's too low, there's always an excuse for markets to realize to go down. So this is a very good contraindicator. Well, going to international markets. Speaking about Iran, the trajectory of oil prices will ultimately depend on four variables: how many barrels are physically disrupted, how long the disruption lasts. In a prolonged disruption, whether credible replacement supply, including potential releases from strategic reserves, can be mobilized quickly enough to avoid a structural tightening of the global oil balance. Even though traffic through the Strait of Hormuz has dropped to near zero, this is largely precautionary after insurers warned that they would cancel policies and raise premiums rather than the result of direct attacks on the waterway. So flow of ships has been on the halt, but mainly because of afraid of losing insurance. To restart traffic, probably the U.S. Treasury could provide insurance or guarantees for ships transiting the strait, a step it has taken in past crises. Okay. Now there is a different theory here from Zneb Riboa, which I found very interesting. A friend of mine shared with me. A good friend. The Iran question is all about China, which makes some sense because in June 2025, Israel launched Operation Rising Lion, a 12-day campaign of precision strikes that destroyed Iranian enrichment facilities, killed over 30 senior commanders and a dozen nuclear scientists, and drew the United States into direct strikes on 3 nuclear sites. In late December, the largest protest since 1979 erupted across all 31 provinces, fueled by economic freefall and a population that no longer believed in the regime's strength. So the government responded with massacres that killed thousands, prompting the European Union to designate the IJC as a terrorist organization, further increasing the isolation of the regime. Yet China was moving to put it back together. This week, it was reported that Tehran was close to finalizing a deal for Chinese made supersonic anti ship cruise missiles. Weapons capable of threatening American carriers now massing in the Persian Gulf. See, this is very important. I remember reading this in the news. This is probably the news that sparked all this reaction from the Western side. Uh, it was also said that earlier Chinese suppliers shipped over 1,000 tons of sodium perchlorate, a key missile propellant ingredient, to the Iranian port of Bandar Abbas, enough to rebuild a substantial portion of the ballistic missile stockpile that Israel had just spent 12 days destroying. See, as long as Iran's missile stockpile is not completely drained, stress will still prevail in the markets, okay, in my opinion. So those are two very important uh, things that happened last week. This is, in my opinion, what sparked the American strong and quick reaction. Uh, Regarding the relationship between Iran and China, we start with oil. We know that because of the American sanctions since 2021, the cumulative value of the purchase has exceeded $140 billion. So this makes China the main reason the Islamic Republic has not gone bankrupt. They have been buying oil from ghost tankers and paying cheaper price, therefore saving billions of dollars. This arrangement works beautifully for Beijing. It gets cheap oil for its industrial base and acquires durable influence. Okay. The 25-year comprehensive strategic partnership signed in 21 between Iran and China is committing China to invest an estimated 400 billion across Iran's energy, banking, telecoms, and infrastructure sectors. And why this is really about Taiwan? Trump did not launch Operation Epic Fury to only punish Khamenei for his massacres. He launched it because every day Washington spends managing Tehran is another year Beijing buys in the Pacific, and the administration has decided the trade isn't worth it anymore. The orientation of the Middle East will determine whether the United States can prevail in the defining confrontation of this century, a Chinese move against Taiwan. If the Middle East has already drifted into Beijing's economic orbit by the time that crisis arrives, China begins the confrontation with a strategic energy reserve that American planners cannot disrupt. A Middle East restructured toward stability where Iran's proxy architecture has been degraded and Gulf partners are aligned can be managed with a lighter footprint, freeing decisive combat power for the theater that will define the century. Oh, going to markets now. See, Italy uh, is rates have been going down with the other countries. You have Italy, we have France. We, it looks like there's an opportunity here to be short bonds, long rates. They dropped very fast. Not sure if they will continue this way. Their stock market we have to watch because they export a lot of luxury things to China. Uh, Japan, as I said, the main driver of this disinflation policy was the drop in gasoline prices. Well, what happens now? that if gasoline price have to go up, have to ask. These are the losses that we mentioned. We still know that they are under a monetary contraction, trying to contain inflation. Uh, it's been working so far, reducing rates, but we always have to keep an eye because the trend is up, and this will hurt a lot of people and may initiate repatriation from foreigners holding all their assets, especially because the yen is depreciating again. This is a critical level, 157. If it breaks 159, we'll probably see the market very stressed, okay? Japanese equities have been a protection against money debasement. They have been going up by a lot last year. And now going to China, we see bonds are still on the 180 area, not doing much, not moving much. Their currency has lost a little bit of value on this last session, but has been on a big downward trend based on its huge exports. Chinese stocks, on the other hand, they are climbing today because last week the others were climbing and they were falling. So now it's opposite direction. It's been very uncorrelated with the rest. Still bullish graph here, climbing to new highs, fresh new highs. Iron ore is going lower. This is the third main product that Brazil exports. If it goes up, it will probably help the real. And it's also a measure of Chinese economic activity in the old sectors. The emerging market dollar index is climbing a little bit today. Still has been dropping a lot since Trump took place, since Trump became president. And here we can see the euro Norwegian krone ratio. If it's going up, as we said, it means the market is worried about the oil price. You see what happened? It totally collapsed. But before collapsing all this way down, when it was here, we said, no, and market was worried about the oil price, supply glut, etc. We said it doesn't look this way if we derive it from this currency pair. But now it looks a little bit exaggerated. May probably be a point to take some profits here. UK, same direction, rates going down, currency losing value against the dollar, rates going down for Germany too. Their stock index close to the highs still. The euro sideways, not moving much. Market is awaiting to see what happens to the dollar. Take a direction for the rest. And here we are, oil. Oil was trading near its lows. We warned that this was a dangerous situation. It wouldn't stay here for much longer, and it didn't. Because the ratio between oil and gold was so low. We can see it here. It's much lower than COVID levels. We must remember that gold is a form of money that can be used for buying oil if you want. So this ratio is important. Which this is oil in real terms, right? Against silver, the same thing, very low. So we were skeptical of selling oil based on the oil supply gut theory. And gold, once again, safe haven, climbing, reaching its highs. Let's see if it is going to do a U-turn and start dropping again, or if it's going to break through and attract new buyers on panic here, okay? Silver is still a little bit far from its highs. It moved parabolic higher at this point in time, and now it is going slower. Copper, uh, very well bid, still related to technology, electricity. Same thing for aluminum, but still linked to the old economy, still lagging totally sideways. Soybeans have been on the rise. This is good for Brazil. And wheat, we like to watch it because, well, Brazil doesn't export wheat, but for the rest of the world is a very important source of food. And if its price starts climbing, we may see social unrest in other parts of the world, okay? As it happened in the past before. Here, just out of curiosity, you see the demand for electricity. Data centers nowadays are consuming more than a big country like France, almost the size of Germany, and is projected to go to fourth location, right behind India. And calls our attention here that China is twice the US in energy consumption. This is something I took from the IMF site, okay? Going to Brazil. Well, XP did some simulations because Brazil exports oil. Every $10 improve our trade balance in roughly $10 billion, and also improves the central government balance in 10 billion reais. The only problem is that it also increases inflation, current inflation, 40 basis points roughly. Okay. Presidential election, Lula will probably stay in this 50% area. Flavio is again climbing 33%. Market is not paying attention to this right now, at least not today. And what another thing that called my attention regarding commodities in Brazil, etc., how we are on the spotlight, is that for the first time in many years, I've seen on LinkedIn people looking for commodities portfolio managers and traders. It is very interesting because a lot of people want to get involved in commodities right now, and this is reflecting on places and hiring. Oh, so this is an interesting trend, which benefits Brazil. From JP Morgan, we just had an update on their LATAM equity strategy that their US investor is optimistic with Brazil. Because LATAM is in a sweet spot, especially Brazil. We have exposure to commodities. We are backed by President Trump's Monroe Doctrine. The regional political setup is moving to the right. Weak US dollar is helping. And Brazil is by far the most liked market in the region and one of the most overweight within emerging markets. And Korea continues to have big fans because of technology too, I think. What calls the attention here is that they say this goes beyond the typical emerging market investors. We talked to global clients, special situation funds, Middle East investors, infra funds, all interested to hear the story. Flows, daily flows, foreigners buying, red, sorry, green means here means foreigners are buying, institutional local investors are selling. Uh, Small investors not doing much. Financial institutions very well balanced, also not doing much. So it is local funds selling to foreigners. Exchange rate, the BRL. Third week of February, according to BTG and the central bank, the FX flow was positive, 1.9 billion. And which is interesting when you see the financial segment once more uh, offsetting. So in the month to date, the flow is positive in 3.4, and we can see here that the accumulated flows are much less negative, and financial flow have been much stronger than trade flow. So this has been helping the real reach new levels here, new lows. Today it is suffering a little bit, but it was very close to its lows. We mentioned last week that Brazil protein exports, the volumes are surging, the prices are steady or climbing also. This is good for our trade balance. We spoke about our studies comparing the exchange rates using M2, that Brazil should lose more value. Brazilian real should be more devalued against the dollar. But when you account for the cost of carry, that we have been pulling forwards and backwards at the same time on the, I call contraction, the blue areas in real. We have much sharper contractions and expansions, and the US, because of its credibility, has much more expansionary areas, albeit not very strong ones. Only COVID was different. So when you sum up all these areas and recalc, uh, the end resulting is that the real should appreciate. The real wins when you have when you compare money dilution plus the carry. The thing is, as long as the government debt is repaid, okay? Uh, we also have a study here. We adjusted real estate, average real estate national price. We adjust by M4. We can see that it is very low. I see an opportunity in real estate in Brazil. When we adjust for gross nominal income for workers, it is also on the lows. So, at least for me, if you compare with gold, at least for me, I think there's an opportunity if you think as uh, real estate as an investable, a real asset, it is a good opportunity here because it generates income, and after all, it is a real asset still. Implied inflation for Brazil 10-year almost at 6. January 33 DI. Market sold heavily. The price did not move, but the market sold heavy volumes here. The 27 shorter ones, more prone to political, to monetary policy. Has made a little pause, launch a doji here. Some parts of the curve are already pricing sub 12% rates, like 11.75. And I made a small comparison using the January 27 price and against how much would it be worth if the coupon was to create a 300 points easing. So here we are now at 13.28. You will make 13.7.4 points. I think risk return here It's not very good. Better sell on stress. This was 90 days a few weeks ago. Ovespa first time negative bar for weekly close, big volume. Today it is going lower again. So uh, you have to see what happens if this will be seen as a buying opportunity, which looking at price behavior today probably looks like because of the commodities thing. Investors will probably see this little dip as buying opportunity. Amazing. Uh, because foreigners have been the main drivers of this market, small caps are lagging. This is the ratio between Ibovespa, which is large caps, against small. You can see that it's at the highs. Bovespa divided by M4 climbed a lot, but still away from the peaks. EWZ, which is MSCI Brazil in dollars, good performance. Stanley Druckenmiller buying Brazil, we heard. Uh, very strong trend. When we compare the WZ to EM, we see if the average of the ratio is here, Brazil could climb another 16. It could climb another 30% to go to these levels easily. Against Mexico, Brazil also looks cheap, not as cheap as it was here, but still cheap because of the past. Against Russell 2000, we are doing better because Russell 2000 is being not performing very well. Against SPY, I don't like to make this comparison because they are so much different. But anyway, we were at such a low point that he had to reverse something, and it did. Small caps against the DI future rates. Small suffered a little bit. You may see a buying opportunity, first buying opportunity here. And this is a small against a portfolio of fixed income securities on rolling through time. You can see that small still has a lot of room to recover if there's a structural change in Brazil, okay? Here's the price for corn, which is a very important for meat and poultry producers. We see it's working between its average. If you break the average higher, it doesn't look that is going to do it very soon. But if there's a big drought in March, it may move. And coffee prices is still drifting lower. They were very on the very strong on all-time highs, but now they have receded a little bit. So the conclusions are small caps in Brazil are still lagging. Not much foreign investors are looking for them. Foreign investors are still looking for the carry trade in Brazil, are still looking for mega caps. This dip today will probably be seen as a buying opportunity, and we may tag along and increase our exposure here. I think that's it for this week. I thank you for your audience. This is not investment advice, just for educational purposes to see how our meeting unfolds, what indicators we look at. And please like and subscribe to our channel. Thank you very much. Have a nice week and good luck.